Let's talk about a scenario that makes many investors nervous: the bear market. A bear market, typically defined as a 20% or more drop from recent highs, can feel scary. The news is full of negativity, portfolios are down, and the temptation to sell everything and hide under the bed is strong. But here's the secret: a bear market isn't just a period of loss, it's a period of immense opportunity. For long term investors, bear markets are where true wealth is built. Today, we'll cover why bear markets are actually good, the biggest mistakes to avoid, and the smart strategies to employ when the market is falling. So, why is the bear market actually good? It sounds counterintuitive, but bear markets are a healthy, necessary part of the economic cycle. They clear out excess. Bull markets often lead to overvaluation and speculative bubbles. Bear markets correct these imbalances, bringing asset prices back to more realistic levels. Another thing is that they offer discounts. Think of it like a massive everything must go sale on quality assets. Companies that were once expensive become affordable. This is your chance to buy great businesses at a fraction of their peak price. And lastly, they reward patience and discipline. Those who stay invested and continue to buy during a downturn are the ones who reap the benefits and the biggest rewards. When the market eventually recovers, history shows that every bear market has been followed by a bull market, often reaching new all time highs. Now let's talk about the biggest mistakes to avoid. The emotions of a bear market can lead to costly errors. Avoid these at all costs. Number 1, panic selling. This is the absolute worst thing you can do. Selling when the market is down locks in your losses and prevents you from participating in the eventual recovery. Remember the old saying, you haven't lost money until you sell. Number 2, trying to time the bottom. Don't try to predict when the market will stop falling. No one, not even the experts, can consistently do this. You're more likely to miss the rebound than to perfectly nail the lowest point. And number 3, stopping your investments. Many people get scared and stop their regular contributions. This is a critical error. You should be accelerating your investments during a downturn, not pausing them. And now, let's talk about the smart strategies for investing in a bear market. Here's how to turn a scary market into a wealth building opportunity. First, there's dollar cost averaging, or DCA. You need to continue to invest a fixed amount of money at regular intervals, like $100 every 2 weeks, for example, regardless of market fluctuations. The reason it works is that when prices are low, your fixed investment buys more shares. When prices are high, it buys fewer. Over time, this averages out your purchase price and reduces your risk. It removes emotion from the equation. Number 2 is focusing on quality assets. During a downturn, focus on investing in financially strong companies with solid fundamentals, low debt, and a history of profitability. These are the companies most likely to survive and thrive when the economy recovers. And of course, also make sure to invest in ETFs. You don't have to bet on individual stocks. Instead, you can just buy the entire market, which basically always recovers. Number 3, rebalancing your portfolio. Use the bear market as an opportunity to rebalance your asset allocation. If stocks have fallen significantly, your bond allocation might now be too high relative to your target. Sell a little of what's performed well, like bonds, to buy more of what's fallen, like stocks. The reason it works is it forces you to buy low and sell high, in a disciplined way, ensuring your portfolio stays aligned with your long-term risk tolerance. Number 4, have cash on the sidelines, but don't hoard it. Maintain a strong emergency fund, 3 to 6 months of expenses, in a high-yield savings account. Beyond that, consider keeping a small percentage of your investment capital in cash, ready to deploy during significant dips. The reason it works is cash gives you the flexibility to take advantage of buying opportunities without having to sell other assets at a loss. And number 5, educate yourself and stay patient. Use the bear market to learn more about investing. Read financial books and refine your long-term strategy. Most importantly, practice patience. The market will recover, but it might take time. The reason this works is knowledge builds confidence, and confidence helps you avoid emotional decisions during stressful times. Bear markets are temporary, they are painful, but they are also profoundly beneficial for long-term investors who can maintain discipline and perspective. They are not a time to panic, but a time to execute your strategy, buy quality assets at a discount, and set yourself up for significant wealth creation in the next bull market. Don't fear the bear. Embrace the opportunity it presents. Of course, none of what I'm saying in this video is financial advice. Make sure to always do your own research. If you enjoyed this video and you want more no BS videos about wealth building and reaching financial independence, make sure to subscribe to the channel. Please like the video if you enjoyed it. Thank you for watching and I will see you in the next one.